Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast for the week ending on October 25th. My name is Ian Saunders, and we are thrilled this week to be joined by a special guest, Brendan Ahern with KraneShares. Brendan, thank you for joining us.
My pleasure, Ian. Yeah, great to connect.
Yeah, it's great. It's always great to see. I know there's a lot of movement going on in China, and we definitely want to get your perspective and your take from the expert on what that movement is. But for those who might not be familiar, go ahead and give you a quick intro. Brendan is the Chief Investment Officer at KraneShares. I believe you joined KraneShares in 2013, so you've been with the firm over 10 years now. That's awesome. Moving forward, so you lead the firm's research education efforts. I know you work with a lot of investors, both domestically and internationally as well, around investing in China and other areas, ranging from asset allocation to trading to kind of talking about the difference in growing influence that different index providers hold across the asset management industry. I know you work with several other firms prior to being at KraneShares. Won't run through all of them here. But I know that you have a lot of experience in the space, and certainly we're thrilled to have you join us here. I do want to make a shout out to mention here as well. You do have a blog. Is that fair to say? Is that what
Yeah.
it, kind of essentially what it is? China Last Night. So ChinaLastNight.com. I know it's a great way. I read it almost every day. Try to read it every day. That kind of just talking about providing an update each morning on what happened while we were asleep, right? What's going on in
Yeah.
China. So for those that are interested in this conversation, I'll give a shout out later. And definitely want to kind of keep up to date. ChinaLastNight.com is a great way to stay up to date. But Brendan, thank you very much for hopping on here. I know there's a lot of action that's been going on in China, and a lot of that we've seen different rallies and different a lot of movement across Chinese equities over the past few years, but everything really kind of seemed to come to a head almost a month ago at this point, right? With on the backs of a lot of the stimulus move that was coming out of the Chinese government. So maybe if we want to kick things off and hear your perspective, your take on what that stimulus was and kind of what it might be looking like right now.
Yeah, 100%. I think part of the question would be like why, why now? And I think a lot of people didn't think that Chinese government would do anything before the US election, but I think this unprecedented action we've seen is really geared to a domestic issue. And it's not what foreign investors or foreign governments think. It's like what do the Chinese people think about the Chinese economy? And I think that's where the Fed cutting the 50 basis points allow them to unleash this kind of unprecedented stimulus. And I think the reason for why did they launch this is that China's economy has been doing well, really driven by export driven manufacturing. And so the world's factory has been strong based on demand from the US, from Europe, from broader Asia. But domestic consumption in China has been very tepid because of concerns a few years ago around the infatuation with real estate investing in China, as well as the concern from the government that an over-levered property developer could create a financial crisis. You had a pivot to try to tamp down this enthusiasm for real estate investing in China, and that had a unforeseen consequence of collapsing consumer confidence. That as housing prices fell in China, you can see consumer confidence stayed pretty strong during zero COVID. And it was this collapse in housing prices. And the reason for this knock-on effect is that upwards of two-thirds of urban household wealth is invested in real estate. And so if two-thirds of your portfolio comes down, you're going to be more conservative. And so it had this unforeseen consequence of really affecting domestic consumption. And I think you've seen this real policy pivot take place, geared to addressing the housing situation to try to get housing prices. So you had this monetary policy bazooka unleashed where they cut interest rates across the board. Obviously, a lot of those interest rates are geared to the loan rate for mortgages. but they lowered the definition of a first-time home buyer to try to create more buyers. They uh, pushed through a 50 basis point mortgage refinancing. That gives about 150 billion RMB back to Chinese households by having this refinancing. They lowered the amount that has to be put down on a down payment. They did lower a lot of intrabank lending rates. They lowered the amount of money that banks have to hold. So there's more capital banks can lend, but really a dramatic effort to try to get housing prices stabilized and up. We also saw at this PBOC meeting that they would allow mutual fund families, insurance companies, and brokerage houses, they could actually borrow money to buy stocks, which we've never seen before. And then they actually publicly, the governor of the PBOC said, if that doesn't get the stock market up, and that'd be more the Shanghai, Shenzhen stock market up, we'd give them more money. And to support the stock market, they actually said they would lend money to companies to buy back stock. So this was on a Tuesday, September the 24th. That was followed by another kind of unprecedented. This President Xi in the top echelon of the Chinese government came out and said, we're going to do more fiscally to support domestic consumption. We're going to do more to try to raise employment in China. We're going to support the banks and their role in the economy. And again, this was really unprecedented. And since then, we've actually seen, say, the Ministry of Finance had this press conference on a Saturday saying, here's all the things we're going to do to support, the top of the government saying, it's time to support the economy, domestic consumption, local governments. Again, really a dramatic pivot from the Chinese government really not doing a lot to support the economy to just a real 180. And again, they have a lot of dry powder that, they didn't do a lot of stimulus during zero COVID. So we think they've got, a lot of dry powder. And again, what we're really waiting for is more fiscal policy. And that requires, they'll probably be at the end of October, beginning of November. It's called the National People Congress. It's kind of like their version of Congress approving a budget expenditure. So the President Xi can't say, go expand the budget. These government agencies can't do this fiscal. It actually requires this approval, which should be just a few weeks away. And again, probably more geared to domestic consumption fiscally, but obviously really unprecedented action in terms of policy support, monetarily toward housing and also the stock market.
Wow. I really liked your term there, the stimulus bazooka. I think is something I'd heard from others. I thought something that was interesting. I mean, so you mentioned this was an unprecedented move in terms of the especially on the stock market repurchase side of things.
Yeah.
Do you see that? I know that the Fed here domestically likes to say that they're agnostic from the stock market movement, agnostic politically. Do you see that's different in China? Do they have kind of their finger on the pulse a little more and like to provide some more influence historically?
I think one important thing to recognize is that so far this year, the Shanghai and Shenzhen stock market, and I mean, just using our tickers, KBA, like it's MSCI China, so Shanghai, Shenzhen stocks, those are 95% owned by investors in China. And that market struggled, which is almost like the local population saying to the Chinese government, you're not doing a very good job with the economy, and and politicians, the government in China really does care about public sentiment, that they're not immune to it. And this kind of malaise around domestic consumption, that's a problem, if you're the Chinese government. Governments, you know, are not, they're the politicians, and whether they're in China or here in the US, they want a good economy, they want a good stock market. What they're also doing, Ian, is saying we want to create an alternative to this infatuation with housing. And if you can get the stock market up, doesn't that move money from this? Again, most investment from Chinese citizen goes into housing, but if you can make the stock market a good vehicle for savings, that's a good thing. So I think it's a dual, it's kind of a dual mandate there. And it's funny, in China they call the PBOC Big Mama, and they call the PBOC Big Mama because you don't want to get in the way of Big Mama. Is kind of the kind of the joke. And if the PBOC is saying this is what you're gonna do, you don't want to be on the wrong side of that trade. And so I think yeah, it's we don't have, say, the Powell put, but you maybe have a little bit of a PBOC put.
Okay, that makes sense. What about the I mean, so domestically in China, are they repurchasing, I mean, from the government perspective as well? And how are they going about doing that? Are they purchasing individual stocks or ETFs, or how does that look?
Yep. And over the last year, you've seen China's sovereign wealth fund, it's called Central Hujian, say publicly state we're buying stocks, we're buying ETFs. They've spoken about expanding the equity allocation in the Social Security Fund, the amount that insurance companies can invest in equities. This is the kind of, they call it the national team. Um, and so that's kind of government affiliated agencies. And what's interesting about that behavior is it's been really geared to the mega cap stocks that influence indices. And then they're buying these mega cap ETFs. Now they're not buying all 5,000 stocks in China. They want it. They know, kind of like Mag 7 with the S&P 500, right? If Mag 7 goes up, it doesn't matter what the other 493. And that's where we've kind of said to investors, and we kind of say, like, listen, this is, again, self-serving, highly biased. Like, yeah, they're focused on the stocks in KBA, the mega cap names, because it has the most influence on the indices. And that's why you're seeing a lot of emphasis from this kind of national team, Central Hujian. But you're also seeing the government saying to brokerage houses, we want the stock market up. You should have people buy stocks. So over their big public holiday, all these poor stockbrokers in China didn't get to go on vacation. They had to stay in the office because they stayed open to allow people to open brokerage accounts. And that's where, there's been some skepticism on this rally. But I'm like, if the Chinese government told people to buy stocks and the stock market goes down, that'd be an incredible credibility failure, which would be really, and so, I don't think they want the market to go straight up. They'd rather have it kind of go up, this slow grind higher. But I think from a credibility standpoint, you'd say, they really want the market higher. And there's valuation reasons and buybacks to support that. But from a credibility perspective, they've said, we want the market to go up.
Right. And so and up it has gone largely for the past month or so. I mean, when looking at some of the performance, so maybe diving into some of your funds, you mentioned KBA, the KraneShares Pulsera MSCI China A50 Connect Index ETF. So that is providing more direct exposure toward the A shares, which is what the mainland investors are going to be looking toward. Would you maybe talk about how that's set up relative to maybe how some of your other funds might be different?
Yeah, I call it onshore China, the Shanghai Shenzhen. It's owned by domestic investors. So it really is that real-time consumer confidence for the government to know what individuals think about China, about the government, and where the economy is. And so it's an area we've been very focused on because of the knowing that's what the government cares about. On the other side is we call it offshore China. So it'd be Hong Kong stocks as well as the US listed ADRs, which because those names are mainly growth stocks, that's what foreign investors are really interested in. Do you really want to hold a bank or an energy stock or a materials? Yeah, maybe it's cheap, maybe it's got a big dividend. But I think foreign investors, when you're looking to invest outside of the US, you're looking for growth. And a lot of those growth companies list outside of China because they want to be part of the global capital markets, global indices. And that's sort of self-servingly, I kind of say, KWEB is kind of this China growth factor. And those are the names that I think foreign investors will kind of gravitate back to that, you'll come back to the Alibabas and Tencents and Meituans and JDs and these kind of growth geared companies. And arguably that we were seeing that a little bit in terms of the price action and yeah, we were, there's going to be pullbacks, things. But I do think foreign investors will gravitate back to these growth names, which are predominant. I mean, there are, little areas like electric vehicle, battery, clean tech, healthcare. But these big growth names, I think, are where foreign investors will be very focused.
That makes a lot of sense. But when you look at the performance, right? I mean, KBA is outperforming not only KWEB on a year-to-date basis now, but also outperforming the S&P so far this year. So it's pretty, to your point on the mainland investors really listening to their the telling to go out and buy stocks. I mean, that's definitely got to provide a pretty good backdrop for the broader equity class, both domestically listed and then foreign listed as well, moving forward.
Yeah. I mean, certainly, and I think it's what gets me kind of excited is that investors are very underweight the space, and then there's been some good reasons for that underweight. The Chinese economy has faced this little bit of a headwind. This real estate. So there's actually a fundamental reason for a little bit of the underperformance, but I think broadly speaking, you have this underweight to Chinese equities, particularly amongst professional investors. And what gets me kind of excited is, if we see this follow through fiscally and the trickle on effect of the economy improving, earnings, this really dramatic underweight to Chinese equities, as that gets rectified, it means a lot of money could come back in. And some investors, hedge funds, they can move really quickly, but real big pools of capital, you got to get the investment committee, the trustees, the board. That's what gets me kind of excited is if this is a real material change in terms of economic policy on stimulating the economy, there's another super tanker that will turn, and that is this investor sentiment, and that will play out. It'll take not just weeks and months. I think it'll take quarters, if not years. And I think that's one reason we're pretty excited about what we see in China today.
And so when you're looking at some of the under allocation, I guess, are you seeing, I mean, obviously flows have definitely been a lot better over the past month. I mean, are you seeing that kind of play out more in conversations that you're having with that people are, I mean, not that everything always follows price movement, but people definitely see price movement a lot of times first, right? Are you seeing that those conversations are coming, people are more kind of confident in movement moving forward?
I think a lot of investors have been underweight, and that's not hurt them. And a 1 month rally in China, if you're underweight, is if you're a professional investor, it's like, whatever, no big deal. But as that becomes a quarter or 2 quarters, your underweight, kind of becomes, tracking error, and then it becomes negative alpha, and then you've got a real, career problem. So I think there's, a lot of people said, this is, I missed the move, and I'm kind of like, no, like I think this is like inning one, arguably, and don't sweat it if you miss that first move, because this is a much bigger change that I think, we think is happening. It's that this is a super tanker just starting to turn the wheel. The rudder is just turning, and but I think this is arguably a much longer term opportunity.
Right. And we ran some data on the kind of the length of the bear market that we saw in Shanghai a few weeks ago. I mean, just in looking at the Shanghai A share index and looking at kind of tracking bear market as your classic 20% decline. I mean, it's high based on our data was September 13th of 2021. And then it took 875 days to ultimately find its bottom, its low, which was February 5th of this year. Based upon the data that we have going back to 2001, that's the longest stretch ever that we've seen for the Shanghai market. So I know that we've seen a lot of movement across China, like you said, over the years, but you would kind of expect after you get such a prolonged period of underperformance that a lot of times that difficulty, to your point, both in China and in any asset class, it takes some work to build people's confidence back up, right? But then coming out of that, we've seen certainly in other assets and in China periodically historically, that you can have pretty decent moves coming out of such an extended period of weakness.
Yeah, yeah, 100%. I think, I think particularly, we're seeing the Chinese buy China. I mean, some of that's through the, I would say buybacks. There's also, we can kind of track money coming out of China going into Hong Kong stocks. It's called the Southbound Stock Connect. The data is available every day on hkex.com, the Hong Kong Stock Exchange. And I think what's important about this is that if you think there's an opportunity happening in China, you'd want to see that the Chinese are buying China. And I think this definitively says yes, the Chinese are buying China through this Southbound Stock Connect. Again, that's buying these growth stocks. The other thing that's happening is you're seeing corporations actually buying back stocks. So these tech entrepreneurs from the Alibabas, Meituans, and Tencents and other, those tech entrepreneurs who are the founders of these companies, and now to the CEO or the chairperson, they're buying back stock. And I think there's arguably some money that from within Asia had been overweight India and China started to come back a little bit, maybe even out of Mag 7, out of Asia. And I think that investor kind of coming back in will happen, geographically with, a lot of investors are from countries where the economy is geared to China. Think about the Middle East or commodity world. And then I think, Europe and the US will be a little bit slower, just because some of the geopolitical concerns or the election. But you're seeing money in motion. And that's, again, part of the reason why we're more constructive that, you didn't miss, you may have missed, the top of the first, but there's, potentially a lot more investors pivoting back over time.
Right, right. And I mean, that's what we're generally Dorsey, right? From our relative strength perspective, that's what we're trying to capitalize on, the meat of the move. And so it was good to see right at the beginning of this month. I mean, we have a couple models with you all. We've had a model relationship on our platform since 2019, and we just launched a new model with you all earlier this year that looks at a more tactical approach to emerging markets, giving it the ability to overweight China by taking on exposure to more of your funds, or underweight China by providing more exposure to KEMX, your emerging markets ex China fund. That model went fully risk on toward China, as much China as it could, right back at the beginning of this month. So
Oh, wow.
in that movement, what that tells us is that model's not supposed to flip on a dime. So when it did, we were seeing a lot of relative strength that had kind of been built up, that should provide some hopefully some staying power moving forward. When we're looking at other rankings and indications we've seen, I know we saw a big spike up, 20, 30, 40% runs in some of these funds a few weeks ago. And some of that price movement has pulled back a little bit. I did want to hit on, I know from our indicators, we saw things get pretty heavily overbought on that move. we would expect, and just if we cover up the name and we just look at the securities price movement, when you see such a massive stem, you would expect some normalization or some pullback and to lead hopefully to some more consistent improvement moving forward. Is that typically what you see from periods of improvement for China, or how has that kind of played out historically?
Yeah, I agree. We had, I mean, and there's some element of the rally in, particularly in Hong Kong names, was probably short covering. That the week before this stimulus was announced in the Bank of America Global Portfolio Manager Survey, the most popular trade was Mag 7, and the second most popular trade was short Chinese equities. And so, yes, an element of that first move was short covering. But I think what's interesting is you've seen, hedge funds are an interesting where, um, they're not married to positions. They just want to make money. And I think, that the hedge fund world can do a 180, in terms of how they're thinking. And, I thought David Tepper, who I have a lot of respect for, what he's done with Appaloosa, his big hedge fund, you know, and to his credit, he's been, I think based on 13 Fs, he's been kind of legging into this trade, but then he kind of said, what we've said is like what just happened is not normal.
Mhm.
And I think that's something that, not every trader can act like David Tepper. Not every trader can just say, just go out and, we're going to go long China. That's not how pensions, foundations, endowments, or insurance companies operate. And that's why I think this is only the early days. And, I think, some of the political headwinds, that some of that is a US centric problem, maybe a little bit in Europe. But for a lot of investors, their economies or their trade partner is China's really important, and they're not they're not encumbered by that burden that a U.S. financial professional. I mean, I always mention KEMQ as a way for a financial professional to, it's kind of like a growth factor for emerging markets. Similar to that, KWEB is kind of like a growth factor for China, but it's a way to kind of almost hide some of the China allocation, but getting exposure to these growth names, not only in China but broader EM.
Right, that makes sense. And when you're talking about different geopolitical movement, I know the BRICS conference, I believe, is going on right now, and China is participating kind of in that. Is that right? What kind of how does that kind of typically go in that relationship? Do you think geopolitically moving forward for emerging markets?
Well, I think Russia has something that some people like India and China and other countries want, which is oil. I think unfortunately, and maybe, I mean, as I was kind of thinking about it, we're probably lucky that this Russian. I mean, can you imagine where oil prices would be if Russia's oil production was totally taken off the table?
It would be
Um,
hard to drive places, probably.
it would be a lot higher. So yeah, unfortunately, just because I think there's an economic interest from India and China and others with Russia, despite this terrible invasion of Ukraine.
Hmm.
I think it's really driven by that pure economic motivation. Um,
It's sort of
Hopefully, it's interesting that Xi and Modi met with Putin, and hopefully, they kind of reiterated like, hey, this is a terrible thing that's happening in Ukraine. But yeah, it's really just driven by that pure economic. I don't think there's a kind of they're best friends or anything like that.
right now. It wasn't insane. I mean, that supply and demand is kind of what we look at our bread and butter. And when you need that demand, you got to find somewhere to get it, right? You got
Yeah.
to find the supply. So that makes sense. When pivoting a little bit, but in the political realm, when you're looking at not to make it too political, certainly, but obviously it's a big vote coming up in the U.S. in a couple weeks, and I know that kind of both sides of the aisle have had different comments around kind of China over the years. Not to talk about kind of projections or what we think, but what do you think based upon whoever wins either side?
Mhm.
What does that look like for China investment moving forward?
I think one, it's key that they did this move before the election, which a lot of pundits said, oh, they're going to wait, but I don't think they really care. And the reason I don't think they really care is that, Biden has been as tough on China as Trump, in terms of keeping the tariffs in place, arguably going beyond that with some of the semiconductor export controls. I think, having, I think, we actually, did a webinar with Ambassador Terry Branstad, who worked for President Trump, was the U.S. ambassador to China. I think Terry would say one that, you got to distinguish between, campaign rhetoric and economic reality. I don't think, Trump's going to do a blanket 60% China tariff. If you do think that, you should be really worried about your positions in Amazon, Walmart, Home Depot, and Costco, because those entities can't exist without Chinese imports. If you think about the economic consequence of 60% tariffs on U.S. inflation, that's where, what Trump did do is, and has spoken to, is really, there's areas where the Chinese government has done subsidies like electric vehicle, and the tariffs level the playing field. Solar, it's an area where they've subsidized that industry, and the tariffs do, they level the playing field. It makes it a fair market, as it should be. Uh, I think the other thing is, some of this could be kind of the art of the deal. Trump actually did a deal with China. Biden never visited China. I mean, obviously, COVID was a real factor there, but I think China will do another deal. If they'll be more than happy to. And certainly, I think it's underestimated from a media or political how much the U.S. needs China, and vice versa. Ambassador, Terry was the longest running governor of Iowa, but you know, Iowan, a lot of farmers need China, pork and soybeans. The other interesting thing about Terry is that he actually knows Xi, that they met in the 1980s. And, when we did this webinar, which is available on our website, he kind of speaks that, Xi is an intelligent person. He's pragmatic. He's rational. He's a good politician. He's attuned to what the Chinese. He needs stability, and a lot of I kind of mentioned that Terry's maintained this relationship with Xi for 40 years because he's no Western reporters ever met Xi. No newscaster. No nothing you've ever read about this person is from someone who's ever met him. And here's this guy, Terry, a great, great guy from Iowa who's saying like, yeah, he's not, he's a regular person. It's kind of an,
Wow.
interesting take.
That absolutely is. That's a take that I don't think many individuals would have that kind of perspective on the broader relationship moving forward. Um, well, Brendan, this has been great. Thanks for hopping on and kind of providing some insight here. I mentioned at the beginning, ChinaLastNight.com for the blog to kind of stay up to date with all the other happenings coming up. I believe you mentioned there might be some other news coming out. Was it the end of October, the end of November was when their next meeting is?
Yeah, I mean, I kind of say, there's no reason to read China Last Night every day. It's just when you see something in the news, the research blog gives us as financial professionals, as kind of data junkies, the ability to use data to give a balanced perspective on what's happening. And we're all implicitly invested in China through the incredible revenues generated in China from U.S. multinationals, and Apple and Tesla and Boeing and ExxonMobil, Caterpillar, et cetera, et cetera. All the U.S. investors need those U.S. multinationals to continue to do well in China, and hopefully the politicians can take a page from the business world and get along a little bit better. It certainly takes two to tango.
Right.
So
Absolutely.
that's what the blog is kind of about, of just like, hey, you see some crazy headline or someone on CNBC saying, China's about to go off a cliff. Like, we're just going to apply a data-driven perspective to that.
Right. Yeah. I think the headlines can oftentimes be very misleading. It's Well, it might sell attention, but it doesn't always make the money go up into the right, right?
Correct. Yes.
No, that's great. Well, thank you. I know. So if people want to learn more about KraneShares ETFs, the KraneShares.com is a good place
Yeah,
to go.
100%.
And if you want more information on the model we talked about, either of the models we have on the site, you can definitely reach out to us, NDW support at Nasdaq.com. And we're more than happy to help you out there as well. So with that, Brendan, thank you. Thank you very much for tuning in and or for hopping on this week. For all of our listeners, thank you very much for tuning in this week, and we'll be back to touch base with you next week.
No, thank you so much, Ian. Appreciate the opportunity.